They say the market hates uncertainty, but it absolutely loves a decisive earnings beat. It's like walking into an arena expecting a close fight, and then boom, you witness a knockout. And that's pretty much what just happened with Bank of America. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, we're doing a deep dive into Bank of America, ticker BAC. We're using data captured this morning, October 15th, 2025. And really, our mission here is to try and square that undeniable strength BAC just showed internally, against these significant lurking risks around the banking sector and, well, the stock's prior chart damage.
Yeah, and you've hit the core conflict there. Because while, yes, we're seeing positive futures this morning, giving it a general tailwind, there is this distinct yellow flag waving specifically over the banking sector right now. What's really interesting is the IMF, they just put out a fresh warning about potential systemic stress, but originating not from banks this time, but from the non-bank financial world. Think huge private equity, hedge funds, that sort of thing. And that stress, well, if it actually happens, it could absolutely ricochet back and put pressure on the big lenders like BAC.
But inside BAC's own house, they delivered a blockbuster, didn't they? They posted $1.06 in EPS. Wall Street was looking for what, 95 cents? That's not just a beat, that's a proper knockout. And revenue was incredibly strong too, topped $28 billion. Seems like strength was everywhere. Consumer banking, even a surge in deal-making fees. A real fundamental win.
Fundamentally, absolutely a home run. And analysts seem to agree something like 84% rated a buy or strong buy. But okay, here's the critical part, where we connect it back to valuation. The models are, well, they're fighting each other. You've got one pretty robust model based on that strong earnings growth, saying BAC is worth $61. But then the competing model, the one focusing purely on free cash flow, it pegs fair value closer to $48.
Wait, hold on. A $12 difference. That's huge. What's driving that kind of disconnect?
That gap, that's the real insight you need right there.
Yeah.
It tells us that while BAC is reporting these really big paper profits, they're likely plowing a lot more cash back into capital requirements, maybe regulatory reserves, than the market might immediately realize. And that eats into the immediate cash return, right? So it makes the stock look, well, more expensive under that strict cash flow analysis compared to just looking at the EPS number alone.
Okay, so fundamentally strong, but maybe not as cash-rich as the headline suggests. So what does the crowd think? Are traders buying the great report card, or are they worried about the neighborhood? Looking at our research, the sentiment data, it suggests pretty high conviction among the bulls. Short interest is incredibly low, just 1.53% of shares. That's like, 3 days to cover. Bears have very little skin in the game here. And in the options market, the put-to-call ratio is bullish. It's 0.6. So traders are buying nearly 2 call options for every 1 put option. Bullish bets. Plus, you see this massive wall, this concentration of call options sitting right at the $52.50 strike. That seems to be the immediate target everyone's watching.
Right, and this is exactly where the plot thickens. Because that strong, current bullish sentiment, it stands in direct conflict with the technical picture heading into the report. Before this morning's beat, the chart was looking decidedly grim. The stock had actually broken below its 200-day moving average. That's a key institutional sell signal, And volume indicators were showing what we call active distribution, which is just technical jargon meaning smart, large money was actively flowing out of the stock. Not trickling, flowing.
Hold on a sec. If the technicals were decidedly grim before the report, doesn't that kind of suggest the smart money was already skeptical? Maybe sensing that underlying IMF sector stress you mentioned? So why didn't this huge earnings news just completely overcome that immediate deep damage on the chart?
Exactly. You got it. That old technical damage, it serves as a reminder that those systemic sector risks, they are real. They haven't just vanished because BAC had one great quarter.
Yeah.
However, the verdict right now, I think, has to lean cautiously bullish. The fresh earnings beat is just such powerful new information that it temporarily invalidates that lagging technical data for now. And this is a big but, we absolutely cannot afford to ignore the existing bearish damage on the chart or that legitimate macro headwind from the IMF warning. Those are still there.
Okay, so that really defines the battleground for the next few days then, doesn't it? Bulls need to immediately push the stock decisively above that technical breakdown area and clear that major options resistance, that psychological key level at $52.50. That's the mission for the bulls.
Yeah, absolutely. And conversely, the bears. They're going to aggressively test the major option support level. And the critical invalidation level for this whole bullish idea is really $49. If we see a sustained close below $49, well, that tells us the earnings strength just wasn't enough, not enough to overcome the underlying weakness in that sector fear. And if that happens, the cautiously bullish thesis is completely off the table. Done.
Got it. So Bank of America delivered the goods, a really strong report. But now it has to prove it can outrun the shadows hanging over its sector and shake off that pre-existing technical damage. It really is a classic tale, isn't it? A great report card, but in a really tough neighborhood.
That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.